News, there's been a lot going on in the banking world. If you have been following the news, and I want to help you kind of understand a little bit about what's going on. So there's this bank called Silicon Valley Bank, SVB. I always say it wrong. I always say SBV. I don't know why, but SVB. And over the weekend, they became insolvent. Not really insolvent, but they had a run and they had to get shut down. So what I want to do is, for those of you who maybe aren't as fluent in the language of the banks and you're hearing all these words, I want to kind of break it down and explain to you a little bit about what happened. So you're going to need to learn a few things and really have a good understanding of what's going on. But the point of this isn't just to help you gain knowledge, it's to help you understand what might happen in the future. So really the question I want to ask is it going to spread? So let's take a step back. I'm going to draw a little bit on the screen for you. My fantastic artwork I'll draw if you promise not to laugh at me. But let me get this screen shared for you, and we'll go in and we'll kind of talk a little bit about what happened. So the first thing to understand is when a bank takes in money, so you give the bank your money, the bank holds it for you, and they have to have it available to you if you need it. So what they want to do is they want to then take that money and they want to invest it. And their hope is if they're paying you, we're going to just say 1%, their hope is they can get 2% so that the bank then at the end of the day gets to keep a 1% spread. It's called a spread on their money. So by giving you 1% and earning 2%, they're going to make 1% back, keep 1%, and that's going to help them make their money. That's where they make their money from. Now the question becomes, what do they invest in over here? The things that they invest in are going to determine how well funded this bank really is. Now, in the case of SVB, they had about $195 billion, and they owned about $205 billion. So their assets that they were holding for other people were about $195 billion. The assets they owned that were theirs were about $205 billion. So you would look at this and you think, well, they have enough money. If everyone wanted their money all at once, you would be able to get that money out and it wouldn't hurt. But what really happened is if we take this investment bucket and we kind of look down to what did they own, a lot of banks, what they want to own are treasury bonds. Now, there are different types of treasury bonds. There are treasury notes, treasury bills, treasury bonds. They just denote a different time frame of how long that bond is. We're just going to say, for the simplest case, we're going to say bonds. Now, what is a bond? So a bond is basically a debt instrument. So what we mean by a debt instrument is, an investment that you buy by lending a loan to another entity. In this case, the Treasury is the United States government. So you'll take $1,000, you'll give that $1,000 to the U.S. government. The U.S. government now owes you $1,000. They have a $1,000 loan that they owe you, and in return for you giving them their money, they're going to give you a payment. So every 6 months, they'll give you an interest payment. If you buy a 2-year bond and you buy it today, you'll receive interest payments every 6 months for 2 years, and at the end of the 2 years, you'll get your $1,000 back. It's a very conservative investment because you'll get your interest payments, but at the end, you get your $1,000 back. You're not going to lose any money. And while the value of the money may change and, there's inflation and things like that, theoretically speaking, there are some risks, but there's not principal risk. You put your $1,000 in, you get your $1,000 back. Now, here's where the problem comes into hand is if you buy a 2-year bond, and you buy it at, say, a 2% interest rate. So we'll put it right here. You own a 2% interest rate, and it's a 2-year bond. So this is today, and this is 2 years from now. If, say, halfway through this 2-year period, right around here, the Federal Reserve Bank decides they're going to raise rates to, say, 4%. So now the interest rate goes up to 4%. Your 2% bond is less interesting. So if you are in a situation where you want to take your bond and you want to sell it, which you can do, your 2% bond is now worth less than $1,000 because I can go to you and buy your bond and get a 2% interest payment, or I can go to the federal government and buy a 1-year bond because there's only a year left, right? So I'm going to buy a 1-year bond and I'm going to get a 4% payment. Which one would I do? Well, I'm going to go to the government. I'm going to get the new one getting a 4% payment. Now, what you can do if you really want to get your money back, or in the case of this bank, have to get your money back because their depositors want their money out, you can sell it for cheaper. So what happens is, as interest rates go up, the value of existing bonds goes down. So this 2% bond that's worth $1,000 in a year, if I sell it today, I'm only going to get maybe $900 because that interest is so much lower than what people could get elsewhere. So I'm only going to get $900. So now we have this situation where this 2% bond, interest rates went up, the bond value went down. So as interest rates go up, the value goes down. So if this side is value and this side is interest rate, what you'll see is that's kind of what we do. As the interest rate goes up, your existing bond value goes down. Now there's one other thing to think about. In this example here of 2% versus 4%, the difference per year is a 2% difference. So that's going to be $20 per year in added interest the 4% bond is going to get. In 2 years, $20 of different interest means that your bond is actually going to be $40 lower value than just buying a new one. Now, what if instead of buying a 2-year bond, someone is looking to buy a 10-year bond? So this time we have 10 years of $20 less interest. So we have a $200 shortfall. So in this instance, now that you're selling this bond that is 10 years long, you're losing $20 per year of interest. So you have to lower your price because of that. So now in this case where it's a 2-year, you have to lower your price by $40 to get someone to buy it. In this case where it's a 10-year, you've got to lower your price by $200 to get someone to buy it. This is what SVB did. SVB bought bonds at 10 years. They bought bonds at 10 years, not 2 years. So as interest rates increased, the value of their bonds decreased even more because every percentage rate of increase translated to $10 per year less value for every $1,000 bond they had. It doesn't seem like a whole lot, but if you take this and multiply it out at $205 billion, that's a whole lot of lost value that they're now having to cash in. So with bonds in this type of market, the market we've had the last few years, interest rates have been really low. You can get typically a higher interest rate on a longer term bond. So think of it this way. You go to the bank and you get a 15-year mortgage, they're going to give you a lower interest rate than if you take out a 30-year mortgage. If you take out a 30-year mortgage, the bank is losing their money longer and they want compensated more. If you take out a 15-year mortgage, they're willing to give you a discount for the fact that they get their money back quicker. Bonds are the same way. If you buy a 2-year bond, it might be a 2% interest rate. And if you buy a 4-year bond, or say a 10-year bond, it might be a 2.5% interest rate. So what SVB did is they were looking at a couple of years ago, they were looking at 2-year bonds that had a 0.5% interest rate. And they were looking at 10-year bonds that were at about a 2% interest rate. And they were like, let's get some more money and let's take the 10-year bonds. And then market rates started going up. The value of their bonds started coming down. And all of a sudden, someone realized this was happening, is that there might be a problem happening at this bank. Then the moment people started hearing that there might be a problem happening at this bank, Then we ran into the problem of people wanting their money back. Like if your money's in a bank and you hear a rumor that there might be a problem at that bank, you're going to go to that bank and you're going to take your money out. Well, as that started happening, that accelerated the fact that SVB had to sell these bonds off, these $1,000 bonds. They're now selling them at 800, and now they're losing money. They would have been totally fine, and there would not have been a single problem had there never been that run on the bank. They weren't insolvent. They weren't going to go under, but they were illiquid. They were not liquid enough, and they had too much risk in the market in the bond market, and the bond market has been hammered. So this is what's caused that problem. So the question becomes who's to blame, right? We want to know who's to blame. Well, first, obviously, the obvious one is SVB is to blame. They didn't have enough risk management. They weren't making sure that they were mitigating their risk and not having enough risk. They had too much risk, and they didn't manage that properly. The second person to blame is the Federal Reserve. The Federal Reserve raising rates, which they had to do, is what accelerated this from happening. A third person to blame is our current government. Our current government, with the massive spendings that we've had over the last 2 years coming out of COVID, caused the Federal Reserve Bank to have to raise rates. So inflation caused by great spending that we've never seen before, caused higher rates, caused a run on the bank. So that's kind of the trickle of what happened and how we got to where we are. So the question then becomes, will it spread? Will we see more banks doing this? Well, in the Cleveland, Ohio area, the banks that are on the same size as SVB are banks like KeyBank, Huntington, and Fifth Third. They're all right around $200 billion in assets. Now, those banks are older. They're more conservative banks. They're a little more experienced in managing this kind of money. So I don't believe we're going to see the same problems with other banks. And I'm just using the Cleveland area banks as an example, but you go into the national level, there are banks like this all over the country, very big, say large regional banks. And I don't think that most banks are going to have that same problem. I don't think they're going to have the same mistakes that SVB did. So if we see it continue, it will be because of other reasons, not because of this same reason. So I don't really worry about it continuing. Now, I'll show you and I'll tell you that not only do I not worry about it continuing, I went out yesterday and I bought stock in some of those companies because I believe they're going to be okay. So I didn't really do anything really for my clients because we don't play like that for clients. I just, with my side play money, I did because I believe in them, and I thought, let's put my money where my mouth is. Not recommending by any means that you should go do the same thing. But I do want you to know, I believe that. I truly, with all my heart, don't believe we have a problem coming. And I believe that what's going to happen is this SVB thing is going to kind of blow over. And we may have other financial problems, but what really is going to be the question of what happens next is, what does the Federal Reserve do when they meet again? Are they going to raise rates again? Or is this going to cause them to stop raising rates? There will be ripples of this through our economy, because what's going to happen is companies are going to close and potentially close, and people are going to potentially lose their jobs because of it. If that happens, that can hurt the economy a little bit. So we'll have to wait and see on that. I don't think it's not going to push us into a recession, but if we're going into a recession, it's just going to be a recessionary sign that is coming. So what would I do if I were you? One, I wouldn't move your bank. I don't think there's any reason to leave your bank or be worried about your bank. If you are with any kind of new tech trendy bank, you might want to just make sure they're properly collateralized, that they have the right investment management in place. If you're with an old, staunchy, conservative bank, then you should be okay and you shouldn't have to worry. The key is that really what we want to do if you're a bank is you want to be able to not have to sell these bonds today. You want to be able to hold them. You want them to mature, and then you want them to buy, and you want to buy new ones. I'm going to do more videos on this because I think that right now there's a really good opportunity for people to be buying bonds. So I want to explain this a little bit more to you as time goes on. If you have questions, reach out to me. Let me help you out on this. I understand it's a little on the confusing side. I hope I made it simple. I hope my horrible artwork helped you understand it a little bit better. But definitely reach out if you've got questions. I'm more than happy to just have a conversation with you, shoot you some messages, send you some emails, whatever it might be. Other than that, have a fantastic rest of your Tuesday.